Good morning, venture capital. This is Metagame, and today we're asking how one city quietly flipped the VC map, and nobody saw it coming. Everything you think you know about where venture capital actually lives is wrong, and I can prove it in 4 numbers: 119, 39, 70.4 billion, 4.7 billion. Hold those. We're coming back to them. Here's the setup. Every conference panel from the last 2 years has delivered the same sermon. You have to be in San Francisco. The AI wave is cresting in the Bay Area. If you're not proximate to the labs, you're not proximate to the deals. It's become the consensus so thick you could cut it. And consensus, as any trader worth their Bloomberg terminal knows, is where you go to get poor. The SEC Form D data for Q1 doesn't do consensus. It does filings. Deduped, US only, $10 million and above, pooled investment funds stripped out. Clean signal. And what that clean signal says is this: New York City ran 119 qualifying deals totaling $70.4 billion. San Francisco proper ran 39 deals totaling $4.7 billion. New York wins on points? It's not close. It's not a rounding error. It's a 65% deal count advantage in favor of a city that the venture conference circuit treats like a satellite office. Now, before you reach for the objection, yes, the Bay Area aggregate across 15 cities reaches 72 deals and $29.3 billion. That's better. But let me break this down directly, because the methodology matters here. When you expand to the full Bay Area, Palo Alto, Mountain View, Menlo Park, Cupertino, Sunnyvale, the whole constellation, the capital number jumps to $29.3 billion. But one filing is doing the structural work. XAI's $20 billion round filed under a Bay Area address. Pull that single filing, and the 14 cities outside San Francisco contributed roughly $9.3 billion across 33 deals, comparable to a mid-tier market. The Bay Area aggregate isn't a distributed ecosystem story. It's a one-deal story wearing a regional jersey. Back to the main thread. This is what capital concentration looks like when it becomes geographic. 4 companies, OpenAI at $122 billion, Anthropic at $30 billion, XAI at $20 billion, Waymo at $16 billion, captured 65% of $300 billion in global Q1 venture capital. When those rounds file, they land in Bay Area zip codes. When analysts run city-by-city capital comparisons, the Bay Area wins. But that win is structurally equivalent to one player scoring 50 points in a game where the other team had the ball for 45 minutes. The scoreboard lies. The possession stats tell the truth. The possession stats here are deal counts. And on deal counts, New York isn't competing with the Bay Area. New York is lapping it. 119 Form D filings at $10 million or above in a single quarter. That's roughly 1.3 qualifying deals per day across the quarter. That is not a market inflated by 1 or 2 outlier financings. That is consistent, repeatable deal velocity across financial technology, life sciences, enterprise software, media, real estate technology, and consumer. The average implied deal size, total capital divided by deal count, comes out around $591 million. Elevated, but not structurally distorted. San Francisco proper's implied average is around $121 million. Smaller deals, fewer of them, in a city that commands 90% of the AI narrative oxygen. Here's where it gets genuinely interesting. Atlanta matched San Francisco, 39 deals each. That's not a typo. That's Q1 Form ED data. Dallas came in at 36. 2 markets that the traditional coastal venture map treats as aspirational are running deal velocity that matches or nearly matches the city that hosts the AI press releases. For allocators building LP relationships outside the legacy coastal networks, this isn't a soft signal. It's a validated pipeline with a data-backed origination argument attached to it. The broader market context sharpens the picture. The Q1 universe tracked roughly 1,000 deals, totaling $256 billion. 41 of those deals, the mega rounds at $1 billion and above, captured $193 billion, 76% of the capital. 41 deals out of 1,000. That's not venture capital as a distributed risk asset class. That's a buyout market wearing a VC jersey. And the 41 deals that captured 76% of the capital are not spread evenly across the map. They're concentrated in a handful of companies at a stage and scale that most venture funds cannot access. So when deal count fell 11.7% quarter over quarter, while capital rose 14.3%, what that divergence tells you is this: The market is getting smaller at the deal level and richer at the round level simultaneously. Fewer doors opening, larger checks going through the ones that do. For funds not writing billion-dollar checks into frontier AI infrastructure, the geographic thesis that says, go to San Francisco is not directing them to the deals. It's directing them to the press releases. Accel just raised $5 billion for late-stage investing. One fund vehicle, one raise, $5 billion. When a single fund can do that in a week, city-level capital comparisons tell you less than you think, and deal counts tell you more. A $5 billion late-stage vehicle can source from any city. It doesn't need geographic density. It needs company density at the stage it targets. That dynamic compresses the competitive advantage of physical proximity for large platforms. Smaller, city-focused funds operating in New York with genuine sector depth have a differentiation window before the large platforms fully deploy and compress the spread. Menlo Ventures, closing a $1.35 billion AI-focused vehicle in the same reporting window, reinforces the parallel track. Capital is concentrating at the manager level simultaneously with the deal level. The N1 story isn't just about which 4 companies captured 65% of global VC, it's about which fund managers are capturing an equivalent share of LP commitments. The geography and the manager concentration are running the same playbook from different directions. Here's the competitive implication that should matter to anyone building or allocating to a venture strategy right now. If your geographic thesis is calibrated to the mega round layer, if your you have to be in SF heuristic is implicitly assuming that Bay Area presence equals deal access, you are optimizing for a layer of the market where the deals are already done, the valuations are already set, and the check sizes are already above where most funds operate. You're not accessing the AI infrastructure stack. You're watching it from the conference floor. The market that is actually generating deal velocity, repeatable, distributed, sector-diverse deal velocity, is centered in New York, extends to Atlanta, reaches Dallas, and is documented in SEC filings that don't have keynote slots but do have 119 data points. The conference says go to San Francisco. The Form D says go to New York. And if you want to get ahead of the next geographic re-rating before it becomes consensus, you might want to look at what Atlanta is quietly building. Because 39 deals in a single quarter is not an accident. It's a market. Which brings us back to where we started. 119 deals, 39 deals, 70.4 billion, 4.7 billion. The first 2 numbers are New York and San Francisco. The last 2 are the same cities in the same order. New York leads on both, but here's the question the data leaves you with, and it's the one worth sitting with. If 76% of Q1's tracked capital landed in 41 deals, and New York is running 119 qualifying deals at $10 million and above, what percentage of your current geographic exposure is actually positioned to capture the market that isn't in those 41? Because that market exists. It's large. It's documented. And right now, most of the capital chasing the AI narrative is pointed in exactly the wrong direction to find it. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.